Hi, I'm Sandy Botkin, CPA, tax attorney, and former trainer of IRS attorneys nationwide. And I'm the author of the book, Lower Your Taxes, Big Time. You know, one question that I get a lot of is, Sandy, I'm new in business. Do I have to pay estimated taxes? And what are the rules? Or I made a lot more money. Or I made a lot less money. What are the rules? Well, let me share some of these rules with you for self-employed individuals. The first rule is if you don't pay estimated taxes, then you're going to pay a penalty. And these penalties are non-deductible. The penalty is currently around 8%. So the bottom line is if you can make a lot more than 8%, then maybe it's worth paying the penalty. But generally, you want to avoid the penalties. So how do you avoid them? There are a couple of exceptions where you can avoid the penalties on estimated taxes. Number one, the first exception is if you pay in equally throughout the year 90% of whatever tax you owe on April 15th, you will avoid the penalty. It has to be equal payments. You can't do it all in, say, right before the tax return or all in December. It's got to be equally throughout the quarter or you'll pay some penalties. And that's 90%. The problem with that is you got to kind of guess what your taxes are going to be and then come within 90% of that. That's kind of hard to do. There are some safe harbors where no matter what you make, I don't care if you won the Powerball lottery, you can pay a lot less under the safe harbor rule and then pay the difference on April 15th. So what is the safe harbor rule? If you make under $150,000 of adjusted gross earnings, you only have to pay 100% of last year's taxes. So let's say last year you paid in $12,000 in taxes. That includes all taxes for federal, Social Security, all those federal taxes. And the state has a similar rule, by the way. So you can do estimated tax for the state. If you paid 100% of last year's taxes, you avoid the penalty. Even though this year you won the Powerball lottery and might owe taxes on $68 million. You would pay that on April 15th, but there are no estimated tax penalty. So rule one, come within, pay 100% of last year's taxes, and you are safe. But that only works for anybody who makes under $150,000 of adjusted gross earnings. If you make $150,000 or more, then you got to pay 110% of last year's taxes. So much for tax simplification. Congress figures there's no such thing anymore. So if you're making $150,000 or more, then you got to pay 110% of last year's taxes, and you are safe. Now, there's a third rule called the annualization rule. Now, I don't normally recommend this. This can make you and your accountants give you both heart attacks, but if you want to use this, you can. This is for people whose income varies greatly from quarter to quarter. And the way that works is basically the first quarter, you take what income you made, you'd multiply by 4, and that would be your tax for the year, and you'd pay in 1/4 of that for the first quarter. And then let's say over the second quarter, you figure out what your income is for the first 6 months. You would double it. You figure out what that tax would be, divide by 4, or in this case by 2, because it's your second quarter. You pay that in, make sure that amount is paid in by the second part of the year. This works fine if you have income that varies, you're very seasonal, for example, or varies greatly. Generally, you're much better off paying either 100% of last year's tax, unless you make over $150,000 of adjusted gross, and then pay 110% of last year's taxes. Here's an inside secret. What do you do if you didn't pay any estimated tax this year, or you underpaid? How would you like to avoid all estimated tax penalties, even though you're coming to the end of the year and you made no payment? Sound pretty good? Here's how to do it. There's a special rule for withholding. Any amount withheld by you or by your spouse, as long as you file a joint return, is treated as if 1/4 was done in the first quarter, 1/4 was in the second quarter, 1/4 in the third quarter, and 1/4 in the fourth quarter, no matter when the withholding occurred. So let's take an example. Let's say you have a job or your spouse has a job and you didn't pay in enough estimates. You need to owe some money. So what do? You increase the amount of withholding towards the end of the year. You increase it enough to equal what the safe harbor would have been. If, let's say, most of that withholding occurred at the end of the year, as long as that total withholding plus estimated taxes equals the safe harbor, you will not owe any estimated taxes, because withholding works as if it were paid throughout the year, even though it might have all been withheld towards December or towards the end of the year. Withholding is a real secret that people should be taking advantage of. By doing that, you can get rid of most of your, or all of your estimated tax penalties, which certainly will make your life a lot less taxing.